A seismic shift in retirement planning could soon hand you the keys to potentially massive gains or expose your life savings to unprecedented risk. The core of your financial future might be on the verge of a radical transformation, and it's crucial you understand both the dazzling opportunities and the profound dangers involved. If you're like millions of Americans, your 401k is the bedrock of your retirement strategy, typically growing through a carefully balanced portfolio of stocks and bonds. However, a new and highly contentious policy initiative from the Trump administration is poised to shatter that traditional model. This change aims to dramatically widen your investment choices, potentially allowing your retirement savings to flow into private equity funds. And here's where it gets controversial. These funds often deal in far less liquid and significantly more volatile assets, such as commercial real estate projects and even cryptocurrencies like Bitcoin. On the surface, the appeal is undeniable. As Chip Lupo, a writer with WalletHub, explains, these alternative asset classes historically have a higher potential for returns, which is obviously a positive. They also offer a new layer of diversification for your portfolio, which is another good thing. Diversification is a cornerstone of smart investing, and adding new asset types could, in theory, help protect your savings. But this is the part most people miss, and it's a critical warning. That potential for higher returns comes with a drastically increased risk of severe loss. Lupo immediately cautions that investors stand a chance to lose much more money in a short period when venturing into these riskier territories. This fear of sudden significant losses is precisely why many cautious 401k plan managers have historically avoided these options altogether. Concerns run much deeper than simple market volatility. Chris Noble, the policy director for the Private Equity Stakeholder Project, highlights a serious and often overlooked drawback: an alarming lack of transparency. He points out that unlike publicly traded companies, which must regularly disclose detailed financial information, these private equity funds are able to calculate their internal rate of return without any real oversight on how they're conducting the evaluation. There's no visibility into the underlying portfolio assets. Essentially, you could be investing in something without a clear picture of what it truly is or how it's performing. This murkiness creates a direct conflict with the Employee Retirement Income Security Act, ERISA, the federal law that mandates employers must act as fiduciaries. This means they are legally obligated to manage your retirement plan solely in your best financial interest. Noble poses a provocative question that challenges the very heart of this policy. When it's harder to measure the performance of certain investments, it's harder to know, should I be paying this much in fees for investment management if you are not able to get as much insight? Are we potentially sacrificing the sacred fiduciary duty for a shot at higher gains? Now here's the counterpoint that sparks real debate. Some financial experts argue that avoiding these assets entirely is a mistake for long-term investors. They contend that if you have a long time horizon, think a decade or two until retirement, your portfolio has the necessary time to potentially recover from the short-term ebbs and flows of these volatile investments. Lupo suggests a cautious approach for those who do their homework. You should probably put a small percentage, maybe 1 or 2%, into these alternatives if you fully understand them. It's important to note that investing retirement funds in private equity is not a new concept, nor is it illegal. The real change this policy seeks is to normalize it and make it more accessible within standard 401k plans. However, widespread adoption may be stalled until regulatory bodies like the Department of Labor and the Securities and Exchange Commission (SEC) establish a clear framework that guides companies on how to offer these options while minimizing legal and financial risk for everyone involved. So, what do you think? Is expanding 401k options into these high-risk, high-reward assets a brilliant move for financial freedom or a reckless gamble with America's retirement security? Do the potential rewards outweigh the undeniable risks and the concerning lack of transparency? We want to hear from you. Share your take in the comments below. Do you agree with this strategy, or does it make you nervous about the safety of your nest egg?